Good morning. Good morning to all those of you across the UK. And good afternoon to our guests from France and Switzerland. Delighted to welcome you today to our brief webinar on the impact of the pandemic on corporate reputation. Before we get into it, just a little bit of housekeeping. Delighted to have you all with us. We've got about a half-hour presentation. Simon and Greg will take us through, I think, some really interesting findings. Graphically, we'll share the presentation with you after the session and the report that goes with it. But after the Q&A, that's really where we open it up to all of you. Please use the chat function to raise any questions or observations you'd like to share with us. And then I'll call on you to introduce yourself to the speakers and have a chance to have a discussion around it in the time that we have up to the end of the hour. So with that, today we are looking at the year we've just had, for good and for bad, but really what it means for the stewards of reputation ahead. At Echo, we've just completed the 31st annual Britain's Most Admired Company study, and certainly found that many things have been turned on their head in the last year. Many companies have undergone extraordinary transformation in super fast time, and certainly sentiment has been running very high in certain quarters. And yet, I think there's some really important lessons for us all to learn as we rebuild and hopefully build back better. When thinking about our topic today, I just want to remind ourselves of the formula that it's reputation for what, among whom, and for what purpose. Yeah, reputation for what, among whom, for what purpose. The most admired study, and what we're about to see today from Reputation Dividend, turns to a very specific audience, which is the professional observer, if you like, the professional consumer of corporate reputation, by and large, the financial analysts. Yeah, so that's the prism that we're looking at the results today. And I probably hear you say, well, so what? So what? So to answer that so what question, I'm delighted to introduce my partners at Reputation Dividend, Simon Cole, the founder of Reputation Dividend, and Greg Quine, who joins us from the analyst side to really share their perspectives on valuing reputation and how we address the so what behind it. So with that, Simon, over to you.
Right. Hopefully we can get the first deck, or the first chart of the deck up. Ta-da, as if by magic, it appears. Here we go. Right. Well, let's go to the next one, Regine. 2021. Things can only get better, to borrow from 1997, which perhaps, if anybody remembers that, was when we had a period coming out of what for some of us was quite dreadful, but things got better. We've had Brexit, we've had US elections, the trade wars, global pandemic. No one is to be reminded of any of that. But what it's led to is years now, over 10 years of quantitative easing, and now most recently the stimulus packages in the US, in Europe and beyond. And what they're doing is fueling the supply of money, dramatically fueling the supply of money around the world. And that's leading investors to chase what is an increasingly elusive alpha. And we have the markets, the equity markets in particular, running ahead of results, particularly in the US, where perhaps optimism reigns supreme around the world. But the markets generally are heading, are sort of running well ahead of the results. And that all sounds fairly dire, but if we look at the sort of the runes, I mean, they do bode well now for a recovery. Towards the end of 21, it's not yet, it's going to take some time before it kicks in, but things have stabilized. We should see recovery, or we're expecting to see recovery, and it's being priced in towards the end of 21 and into 2022. But the issue for now, and perhaps with some urgency, is what can we learn from all this? What can we learn from what's happened? What in particular has been the effect on the impact of reputation, how investors have consumed and used reputation? What does that mean for reputation management? And the clues to this are really to be found, or there's a lot of clues to be found, in the very tangible value that this most tangible, most intangible of assets actually has. And just for that purpose, this is what we're looking at here, which is the economic or the monetary value of corporate reputation, how that is driven, and how therefore that can be utilized going forward. I know some of the people watching have already seen this before, but excuse me, I'll very quickly recap on how we go about measuring reputation value. If you could move on one, please, Reg. Just very quickly, so this is the only sort of technical slide in the whole deck. But what we're doing in our analysis, we've now been doing this for actually more than 13 years, is focus really on the difference between market cap as expressed on effectively a day-by-day basis, and the value that is explained by the financials of individual companies. And we're quantifying, or we're teasing out and then quantifying the impact of reputation, or the confidence that's inspired by reputation. So it is very much a piece of statistical analysis, a quantitative model. And what we manage to do on a regular basis now is explain something between 92 and 95% of the variation in market cap. We don't get it all, but we get the vast majority. And that's a reasonably solid and sound model of what's going on, effectively a model of investor behavior. We use the data which comes from the likes of Bloomberg, Morningstar, all the sorts of usual financial metrics that we know investment analysts use. And for reputation, at this level, we're using the most admired company studies. Here for this presentation is Britain's most admired companies study, published in Management Today and conducted now by Sandra and Echo. The results or we do the analysis on a company by company basis. So something like close to 300 of the largest companies in the UK in this round. And then we can consolidate the results of those into the sort of findings, or some of the findings, which we'll show you in the next half a dozen charts or so. So if you just move on, please, please, Reg. So the top line or the bottom line, whichever way you look at it, into 2021. So this is all the data is as of January. So spread over the whole month. What we see very clearly is that corporate reputations as a whole have provided critical support to investor confidence as we've gone through the crisis. Let me get rid of that. As we've gone through the crisis. And now something like £1 in every 3 of shareholder value is tracking back to the confidence inspired by reputation. That, as of January, was £823 billion of shareholder value. Gross market cap of the FTSE 350, about £2.5 trillion sterling. More importantly, perhaps, what we saw year on year, so comparing January 20, before anybody had ever heard of COVID, or before many people had heard of COVID, and most recently, we see a marked uplift in the proportion of companies' market caps coming back to reputation. In fact, that's the largest uplift we've seen, a single year's uplift we've seen in any of the years that we've been tracking that, here in the UK and in the US, where we run a similar survey. And it's made up, as I said, of the results for individual companies. And here we see individual companies' reputation contributions, and it's the term we use for the proportion of a company's market cap attributable to its reputation. The range goes from minus 37%, is a small number, around about 20 companies in the FTSE 350, we found to have reputations that were so toxic as to be destroying value. The vast majority are positive, and it goes up to about 56%, the highest single company. And we'll just talk about the leaders. the top 10, if you like, which is something we publish, a list we publish each year. It's a bit more interesting this year because there's been some marked changes in those companies which make up the top 10. Reg, if you can move on, please. There it is at the top, Unilever. Unilever's always been, or certainly for the years that we've been tracking this, Unilever's had one of the most potent reputations. It has been at the top before, but it's sort of slipped up to first place. A combination of reasons, we believe. I mean, certainly, Alan Jope's strategic intent is being understood and appreciated, it would seem, if you look at media comment. There's been a successful unification of the Anglo-Dutch structure, a corporate mission within everything else to, if you like, prove the benefits of sustainability, and of course a strong commercial performance. That's all conspired, come together to improve the potency of the company's reputation at the same time as Royal Dutch Shell, one of the other three major Dutch companies or Anglo-Dutch companies rather, in the FTSE 350, dropped to number 15 from first place. Second place, and it's probably a little surprise, AstraZeneca, but over and above everything that's been happening with COVID and coronavirus, Pascal Soriot's transformation of the company in the time he's been there, in intentions with regards to developing in China, acquisition of the $39 billion acquisition of Alexion. I mean, again, all these things have conspired to have a marked and a substantial, one of the largest rises in position, up 17 places to 54%. So we're saying 54%, 53.9% of the company's market cap comes back to the confidence that we're talking about. Confidence that comes from a positive, a strong corporate reputation. A couple of other companies perhaps to comment on. Halma, described in the recent I think Most Admired Companies, or a comment in the Most Admired Companies study report, described it as one of the best companies you've never heard of. Well, its reputation is certainly powerful and potent amongst the investment community and observers of the company. And that's resulted, and the combination of things have resulted in it jumping 13 places to the number 3 spot. The other big mover in there towards the bottom in number 9 spot was Berkeley Group. It's a big jump, but Berkeley Group has been hovering around about the top 10 for a number of years. So to some extent, that was a case of getting back to business as usual. And perhaps the only other company to comment on for now would be JD Group. We hadn't tracked JD Group before, but it's perhaps not surprising when we look and see how the company is talked about by observers and commentators. It is well regarded. It has made some, it's seen to have made good acquisitions. I mean, one in particular in the United States benefited from the $1,200 stimulus check that went to all adults, because, as we know, a proportion of that was spent on athleisure wear or trainers, sneakers. But anyway, it's come in straight at the, I think what's it, number 6 spot, but again, a powerful reputation asset. And overall, we've got something, with companies with a gross market capitalization in January of about 500 billion, 278 billion of that is coming back to the corporate reputation. Each company has a position, a reputation. It's mostly they're there for good. Some instances, I mentioned, they're not so good, but the reputation work is a sort of a dynamic influence. I mean, it is not something that's fixed. It's something we have to sort of keep looking at on a periodic basis to understand how best to manage it going forward. And Reg, if you could just move on a chart, let's talk about 3 of the most important influences on the impact of reputation. And one of them is index, whichever index the company is in. Again, it'll come as little surprise. I mean, size determines index, and size attracts attention, and that breeds familiarity. going in from the FTSE 250, the FTSE 100, there will be automatic inclusion in index funds, and that can that will often elevate value without necessarily great attention or additional attention being played to the hard evidence that the company's financials provide. So index is a factor, and the result is companies in the FTSE 100 are currently averaging a reputation contribution, the darker red line, about 38%, and that's up 9.5 percentage points since the middle of the year, if you like, at the depth of the pandemic. FTSE 250 average lower, but showing a large rise in the period since June 20. So index is a factor. The second factor on the next chart is the sector, the industry sector. And it's probably, if you could move on one, please, Reg. Again, it's a little surprise to see changes in the average reputation contributions from sector to sector. So we have, with the highest uplift, so if you like, the concentration of optimism, of promise, from the consumer discretionary sector. It's being talked about more and more at the moment that come sort of more normal times, there's a build-up of money in consumer resources that will be directed towards, go towards spend. And so companies that are well regarded as consumer discretionary are offering promise. Healthcare, the promise from dealing with coronavirus and COVID. Utilities is in the group leading the uplift, but perhaps more because it was particularly low 12 months ago when it was suffering from expectations for regulation and pricing controls and what have you. And so in a sense, we're seeing a little bit of back to some normality with the utilities. On the other hand, there's been declining sectors where, if you like, the evidence is becoming more impactful in, say, energy, materials and telecommunications. They've all seen a decline in the average contribution reputation. The third and perhaps most important driver is what the reputation is. I mean, the very structure of the reputation. And in the next chart, I'll show that, if you could move. Thank you, Reg. Investor appetite changes and has changed substantially since 12 months ago, through the pandemic when it was becoming defensive, and now beginning to look forward into recovery, into cyclicals. And we're seeing more and more attention being paid than has been just recently, but more attention to the quality of goods and services, the expectations from the quality of goods and services. Again, in anticipation of the recovery for when it comes, companies are likely to be those that can offer value. And in this instance, this kind of recovery, it's more about the top half of the value equation than necessarily the price. So the quality of the goods and services, which are, if you like, creating more interest. The ability to attract talent has become a more powerful driver. And we're beginning to see, I think, more talk about this generally, the notion that companies are going to have to rehire to some degree, sort of get back some of the workforce that they've dismissed over the last 8-9 months or so, and get the right people to sort of serve the needs of the companies towards the end of the year. Capacity to innovate, another factor which is becoming more important, has become more important. And at the same time as these cyclicals have risen, we've seen a declining on the impact from factors such as the use of corporate assets, the competitiveness and the financial soundness, still important, still drivers of confidence and reputation value, but less so, being displaced for the time being by the likes of other factors. So that's all well and good, and that's the sort of snapshot of where things are as of today, as of January. But the issue is how we put all this to work going forward into 2021. If you just go on the next slide, please, Reg. I mean, the issue, the issue is twofold. First, it's about getting through the remainder of what we'll call phase 2 of the market's crash. And that's where the stability, the stabilization that we're seeing at the moment, prior to the upturn, hopefully later in the year. But things will remain volatile. Things that are certainly not secure. They're getting better, but we've got to get through that phase before we can get into the upturn phase. And from a reputational point of view, or stewardship of reputational point of view, that means it's about matching corporate reputation to the demands of the investors. For the near term and for now, it's about securing the value that the reputation currently represents and provides. And that, as we've seen, is considerable. And then it's being ready to pursue the growth potential later in the year. So I'll shut up now. Greg.
Thanks, Simon. Reg, can we have the next slide? So, given that backdrop by Simon, how has the stock market been behaving? Let's have a quick look at that. Well, what we have seen is a steady rise in the market since early November, with a clear shift to risk on since mid-December, with a strong rotation to cyclical stocks away from defensive stocks. I think we can see a little bit of that going on in the market still this morning, actually. In particular, this rotation was driven by increasing clarity in December around the outcome of the US elections, Brexit, as well as breakthrough news on vaccines, adding to the ongoing global stimulus measures, all of which began to power increasing forward earnings estimates. So, if you like, whilst the world in economic and social terms is on its knees, the market is already looking through this to the end of 2021. But I think more importantly into 2022, actually. So it's the back end of 21, but really full year 22. Something that is nicely shown in this chart here, which shows the consistent earnings upgrades on a rolling 12-month forward basis. Interesting, what you see is the US appears to be back to pre-pandemic levels already, or through it, with the UK lagging somewhat. And that perhaps reflects near-term uncertainty post-Brexit. And of course, Simon mentioned earlier, the eternal optimism of the US investor. But you can see in terms of the US, particularly in the last, 6 weeks, sharp uptick in earnings expectations, forward earnings expectations. So this has led to a strong expansion in valuation multiples, especially in sectors sensitive to economic growth, which suggests a pricing of the market to perfection, really. It's leaving very little room for future earnings disappointment. So people are getting very excited, and they're not looking at much prospect of downside. So it's quite peaky if you look at this chart. This pricing, of course, is not of current conditions or fundamentals, as I said, nor indeed for most of this year's earnings. It's firmly one for expectations for really, I think, for strong 2022. And this shows up through reputation in the form of an article of faith, if you like. So what does this mean for reputation managers? Well, it's crucial they look after the now, the next few months, in preparation for the future, for the fundamental economic recovery that needs to follow, that has to follow to justify the current stock market re-rating. The markets are having, for the first time in over a year, better visibility, and are moving so fast. And it's vital that strategic decisions on communications in relation to the value they account for are made now. It really is moving at a pace. Reg, can we have the next slide? So the first thing to do is to look after what we have. Simon alluded to that. Understand what we have right now to make sure we secure this value in hand now. And second, be ready to capture the value growth potential later in the year. Now, the point of the value in hand is that it's not evenly distributed, as you can see in this slide. As we've seen, different reputation, or as you can see here, different reputation characteristics represent different levels of interest to investors, which result in different levels of value. So looking at this aggregate of the whole FTSE 350, the largest contributor to reputation value is impressions of quality goods and services, contributing something like just over 15%, or about 127 billion of value. And if you look at the smallest, it's community and environmental responsibility, which might surprise some of you, representing just under 6% or 48 billion. These assets, without doubt, are significant and must be looked after. And of course, the location of value and absolute level of value varies from company to company. Turning to the next slide, Reg. The implication for individual companies as they need to look at how this plays out for them to understand the first layer of messaging or communications priorities. This chart here shows or compares the average reputation value contributors of the 250s, FTSE 250s, against Marks and Spencer's as an example here. A company with a fair to middling reputation overall. It's okay. It's not bad. It's not great. What you can see is that Marks & Spencer's reputation comprises various strengths, but not necessarily in the right place. For example, if you look at this spider chart here, its greatest strength is corporate environmental responsibility. But as I discussed just previously, this is a factor that overall ranks the lowest in terms of value contribution within the broader index. So that looks great, but it's in the wrong part of the value equation. If you look at the other side, the greatest generator of value within the 250s is value as a long-term investment, against which M&S compares unfavorably. So whilst M&S should nurture or maintain the value it has in corporate and environmental responsibility, any additional investment dollar should be prioritized towards factors offering more upside value potential, such as value as a long-term investment. Next slide, please, Reg. So we've seen what we have. Now we can look at pursuing the opportunity that Simon has talked about and I've mentioned already, right here. Ultimately, companies need to balance messaging and communications for value security and value potential using a map like the one we have here, which will by definition be unique for each company. This one shows an average for the FTSE 350. The horizontal position indicates value extant with the greatest value to the right, while the vertical position shows essentially what return each dollar invested, if you like, will give you. So the greatest return as you move towards the top. This helps to identify your priorities for messaging, for your communications, where you can get the greatest bang for your buck, if you like. Here we show the FTSE 350s, but of course the real value is for each company seeing how they stack up versus this or within this. If you look at this chart of the 350s, quality of goods and services delivers the greatest value of all the reputation drivers, but it doesn't deliver the greatest bang for buck in terms of future invested dollar. Looking at the other bubble, which we've got here called the driver of incremental value, however, you see those factors with greatest growth potential, as well as those currently delivering high levels of value, with capacity to innovate sitting in arguably the sweetest of spots, being present in both bubbles. And on that, hand you back to Simon.
So just to sum up, you could put the next chart up, please, Reg. Just very quickly, and there's only one chart now, so we can get into a discussion, a chat. But how we'd summarize the benefits, the kinds of insight that this analysis, this type of analysis can deliver. It's about helping to mobilize, or the current time, it's about helping to mobilize reputations for the challenges ahead. There are enormous challenges ahead, coming out of the troubles of 2020, getting the timing right for getting into the recovery later on into the year. We get from this kind of analysis hard objective evidence as to firstly the strengths in a company's reputation, individual company's reputation that need to be secured. Those strengths are currently providing value, and that needs to be looked after, or as we know, it can all too easily dissipate. At the same time, it's about providing objective evidence as to where the growth opportunities are. And together, I mean, that starts to set priorities for messaging. It's about timely insight. It's about the now. It's about this is the way things are going as of today. There isn't time to wait 6 months and then hope everything has been retained and everything is prepared. But it has to be looked at as of now. And that's about so we can set up and deploy the reputation asset for the medium term, for the near term, and eventually the long term too. And so altogether, this is a means to power up communications through the messaging, to manage what ultimately is the strategic asset that is the company's reputation. And critically, because the markets are moving, and the markets are moving probably more now, or at a greater rate now than they tend to on a general basis, we can do that and act as of now, and that's what's going to secure the strength of this and secure companies' positions in the months and ultimately years ahead. Full stop.
Brilliant. Thank you both, Simon and Greg, for that whistle-stop tour around an awful lot of data that I know goes behind this. And every company's profile is different. Every sector's profile is different. I'm delighted to open this up to our guests to have a wider conversation with you. Before I do that, I would just, I'm reminded as we go through this together of a dinner I had, gosh, a little while ago with Jonathan Harper, who I know is with us. And we had, Jonathan had as his guest, the chairman of Rolls-Royce. And we were very much talking about reputation and reputation management. And I just, excuse me, remember the comment when I asked our guest speaker, you know, how many boards really get this and really get this space? And this goes back to the question of so what? And the chairman replied, very, very few boards really appreciate the value of this particular asset, and not enough have the processes, the discipline and the resources to protect such an asset. Okay, and I think, you know, it also goes back to where we started when I was talking about, you know, reputation as a prism. It's, you know, reputation for what, among whom, for what purpose. We're not talking about employees. We're not talking about the community. We're not talking about regulators or indeed customers. There are an awful lot of other ways of assessing reputation from different stakeholder perspectives. This is from the consumer, the financial consumer of corporate reputation, and how it affects that financial value that so many boards obsess about. How is our share price doing? How is our market cap doing? This starts to frame it in a way that allows communicators to just have a better discussion around how are the priorities being considered? You know, what do we do? What don't we do? And why do we do it? What's the value behind it? So I know we've got some really interesting questions from our guests from a number of different perspectives. I know Sarah Gori from AXA in France. Reg, if you can find Sarah. And Sarah, if you can unmute yourself. And I know you had some questions around methodology and approach.
Hi guys. Yeah, I'm so I do reputation risk here at AXA, and one of the things that I was wondering is what methodology are you using to value, because as we know, it's very difficult to value this intangible asset. What's the criteria for you to come to the point where you say 1 in 3 pounds are considered? Is this based on Reputation Institute, or is this something else?
We get to that by tracking and modeling a whole host of individual companies. In the UK, close to 300 of the largest. In the United States, it's about 400, a bit more of the largest. And we've gone global as well into other countries. But we're collecting data, financial data for all of these companies, all the usual suspects that you see, so that we know investment analysts look like. So reported earnings, forecast earnings, return on assets, all those jolly good things. And we have data for the strength of reputation. So a simple measure of reputation strength, which comes from the likes of the most admired companies studies. We put that together, and then through regression analysis, we can tease out the extent to which the market cap of an individual company is explained by its reputation. And that's the bit we call the reputation contribution. We then add it all together to get to the FTSE 350 figure. So, you know, the 823 billion or FTSE 100, or whichever. If we want to look at a sector, we just pull those companies in the sector together, whatever it is. It's nothing to do with Reputation Institute, which is, as you know, it's just a measure of.
Okay, yeah, I just wanted to make sure we're okay with something different.
Oh no, it's through our own research and our own analysis, built up company by company to the aggregate results that we've shown in this presentation. If we were talking to you,
right. Okay, so in essence, it's almost taking like what you find in the annual reports, and taking all the financial things from, I don't know, from their revenues to, whatever. Mm-hmm. Does that include things like litigation or, risks that they have in their industry that could impact their reputation? Because there's intangible things within the financial figures that you find that, no matter whether you're great financial, if they come out financially great, but I don't know, they have a culture or conduct risk, that's going to impact their reputation. So.
Yeah, no, I mean,
so I'm wondering, at what point do those soft aspects go
Well,
into?
the reputation is built up. I mean, it in turn it's not a singular holistic thing. It's we build it up from data on individual components of reputation. So what people think of the company's capacity to innovate, what they think of the quality of its management, whatever the factors are. And there's up to a dozen of those headline factors. And we've built up evidence over the years of doing this of how different types of commentary for different types of companies in different types of sectors actually feed into those factors. But it does break it back down to the individual, the headline components of reputation. We see the movements there, and then we can identify what's driving those by looking to see how a company is being talked about. And that's when we'll get to those, I think, much more granular items which you just listed.
Okay, so that's what I was going to say. Also, do take into account how they're perceived also in the media and things of that nature as well.
Absolutely.
Okay, so so that goes into your factoring of each company.
Yeah.
Their
Yeah.
CR.
In a sense, I mean, that's I mean, it's obvious when I say it, but it's a good indicator. I mean, the way the media is talking about a company, not just what it says, but the kinds of language provides valuable insight in just how the world is thinking of, or how the world that we're talking about, people who are interested in a company as an operating entity, how they think about the company.
Right, exactly. Because you have your media, your analysts, your customers, everyone talking. Okay, thank you so much.
Pleasure.
That's a great question, Sarah. And I think one of the most interesting examples we saw was when we happened to be looking at Monsanto many years ago. And Monsanto, brilliant financial soundness, actually really good on innovation, toxic on corporate responsibility, $2.8 billion deficit on corporate responsibility. So factoring in things that eventually have come out to play, which actually turned out to be even larger than that. So it is interesting when you see where the assets, but also perhaps where the weaknesses are. Yeah, and you put it in that kind of, but that was very striking on that issue. And I know when we're talking about corporate and social responsibility and environmental responsibility, something that I think is very dear to my own heart. There was a great question, Michael, if we can find Michael, and Michael, if you can unmute yourself.
Sure. Hi, everyone.
Hi.
Thanks, Greg and Simon. Very interesting presentation. Yeah, I think obviously working for Nestle, this area is one that we're very interested in, and one where we've traditionally perhaps struggled most actually is on the environmental and certain parts of communities reputation, maybe not so much on some of your other metrics. So I was interested to see not necessarily that it was still contributed relatively little value, which maybe is explainable, but there didn't seem to be a noticeable positive trend on that aspect, because that differs a little bit certainly from our experience when our chairman, CEO, CFO go on their road shows, investor calls, interest of ESG funds, that this is really something that is rising amongst the investor community. So how do you explain that? And is it maybe just that it's not filtered through yet, and you do see in the tea leaves that this will grow as a driver of reputation going forward?
Can I take that, Simon?
Yeah, sure.
It's one. I think you probably heard, Michael, when I was talking to him a bit. Actually, I made a point about that. It can be surprising to some people to see the fact that it's quite small and it doesn't seem to move much. So we always look at that. It's one of those things where I think that you'll know more than me about this, but it's a very long-term factor for people, I think, and it's always in the headlines, whether Larry Fink's talking about it or whoever's talking about it. So it's very headline, but it's one of those interesting things that ESG funds are setting up. They're becoming more and more important, but the companies within it will do what they do. So it's not one's helping the other. It's the fact that these things are setting up because society wants these funds to be set up. So those funds go in. When we run this analysis, and this is the interesting thing, when you speak to the financial community, well, not speak to, but actually get the statistics from it, it's one of those things that everyone talks about it. Yes, it seems to be increasing in importance. And then when you dive down into the figures, like we have, the investors are saying, yeah, well, kind of not really, actually. Yeah. So it stays there and it doesn't move very much. And right now, clearly what you're seeing is people are saying, yes, people are talking about Build Back Better. I think, Sandra mentioned it earlier. Everyone's talking about it. Then you look at the figures and everyone's more interested on what are you going to do to drive your business? So it's great to have corporate social responsibility and all the rest of the stuff, but it's still sitting back there in the back seats, which we find really interesting. It doesn't mean it's not important, because it is. It will become more and more important in big companies like Nestle. I know a lot of the Dutch companies like Unilever, DSM, someone I know very well. All of these guys, it's massively important, and they're going to be win factors long term. But right now, you're right. It's funny. It just doesn't seem to shift. But that's because that's what the market's saying, which is that, yeah, right now it's not a great value creator. We'll talk about it. We'll have ESG funds, but not for now.
Sorry, go ahead, Simon. Yeah, sorry.
I'll just add to that with perhaps a couple of sobering statistics, because it is an emotive subject. And as Greg said, it's not that it's not important, it's just that other things are more important at the present time. But if we take the FTSE 350 and the companies that we cover there, and look at them or look at them how they're ranked according to how they're rated for ESG CSR, or indeed how they're in perceptual terms, or indeed how they're rated on those things according to the something like the MSCI index. And from January 2020 to January 2021, I mean, all UK companies, the whole lot, are down about an average of about 14%. That's the index, down about 14%. The top 25% or the top 25% rated ESG CSR companies down about 5%, so less. Whereas the bottom 25% were also down just 5%. In the recovery since the depths of the crash, which was about April time, we've seen the top 25% rated for CSG improve the average market cap by 22%, whereas the bottom rated by 42%. I mean, the point is, it's not about ESG and CSR, it's about other factors which are driving the success of the indexes and the ETFs and what have you that we see being sold separately. And that's coming, I think, perhaps more from consumer, where there is an impact, not so much for investors.
Thank you very much.
I would qualify that just a little bit, because we do see a difference by sectors. Certain sectors is much more fundamental and increasingly so. Don't forget, as always with statistics, we're looking at the average of the FTSE or the average of the CAC 40 or whatever it might be, which encompasses all the different sectors. But certainly certain sectors are more interested, more exposed than others, because it's a risk as much as an attribute. Pulling on again on our great audience, I know we've got Steve Earle and then Jonathan Chandler. So if we can focus on Steve, if Steve, you can unmute yourself.
Hi, thank you. Great presentation. Just briefly to build on the previous question, really. You mentioned the point about matching reputation to investor demands. I guess my question is about objectivity, really, and maybe I can ask it in a slightly different way. What else do you think needs to be done against investors of the objectivity of reputation data? Because they now seem to have much more objectivity around ESG tracking, but is reputation still seen as slightly too much of an art and not enough of a science, given that it's rooted in opinion and belief?
I think we're taking the sort of the latter part of the question. I think there is, yes, measures of reputation are measures of something amorphous, something soft. But that doesn't mean their effects and their impacts are soft and amorphous. The very sort of heart of what we're doing in this analysis is determining just how impactful these things are. So it has to say a very real and very tangible outcome. And equally, I think we might turn the whole thing around and say, well, there's a lot of financial measures which might traditionally be seen as more hard-nosed, but they're based on opinion and expectation. So, but that gets forgotten about in many respects. So it is clear that the reputation is creating confidence, and that confidence is underpinning, if you like, a lot of everything else that is looked at about a company, and it all comes together. I think it's almost a false distinction to try and separate them along those lines.
Steve, has that answered your question sufficiently? Are you happy with that?
Go on, say no.
I got a thumbs up. I got a thumbs up. We'll take that as a yes. Thank you, Steve. Thanks, Simon. Our next question comes from John Chandler. Jonathan, we can, yep. Reg, if you can unmute yourself, John. Perfect.
Can you unmute yourself, John?
Can we hear you? Oh, we've lost your voice. Okay, John, can I read your question for you, if that's helpful? So John asks, the scorecard is a mix of leading and lagging indicators. It is significant that the two most valued are leading, namely the bet that the organization can attract future talent and continue to innovate. Can you comment on that?
Yeah, I think there's a mix of what might be thought of as leading and lag indicators, but we're sort of understanding them as how they're performing and how they're delivering at the present time. Looking to see how they have changed gives us an idea of the extent to which either type of factor can be important in the months ahead. And it's just so that right now, with the state that the markets are in, and with this sort of move towards cyclicals, as Greg was talking about, that perhaps the people are turning their attention to some of these more or described as forward-looking indicators. Expectations for jam tomorrow rather than today.
Thanks, Simon. That leads us very neatly into another question. I'll move straight to Matt Nixon, and then I'll go on to Callum. So Matt, first, if you can unmute yourself, and hopefully your button won't be stuck.
I think it's worked. Is that working? Great. Yeah. Thank you very much, guys. That's very interesting. It takes me back. I was doing stuff on this 20 years ago, and it sort of brought it all back suddenly on intangibles. You said really the data tells you what's moving value now. Is it possible to look further ahead and longer term? So I mean, it might be speculative, but what's your guess on what will be the factors that will really be shifting these intangible values in, say, 5 years' time? Have you got any clue? Is there any trend data or fast-moving stuff you can give us some hints on?
I certainly wouldn't like to suggest anything for 5 years' time. If we were talking a year ago, I think any suggestions of the near term would be sort of thrown out of the water. It's yes, because we're tracking this on a regular basis, because we're measuring the importance of these factors on a regular basis, we can certainly see near to medium term trends, and that becomes very apparent. I mean, looking back at the history of Thomas Cook prior to its collapse, I think about a year and a half before, January 2017, its corporate reputation was looking reasonably healthy. It had a contribution of about 35%. I mean, various component parts of the reputation were all looking quite good. A year later, so actually that was 2.5 years before it collapsed. A year later, January 2018, its reputation was starting to decline, and it was starting to lose momentum in factors like attracting talent, corporate assets, long-term value in particular was taking a dive. January 2019, its reputation contribution was just above zero. And it wasn't until September that the company finally collapsed. But we could see, if you like, factors showing themselves as deserting the company almost some time before the eventual result became all too apparent.
And can I just add on to that, as you just sort of zooming back a bit, Matt, actually, that it's important to say as well that I think we've sort of mentioned it in our introductions, but the trends are very important, as you said. So right now we can look at, I think someone asked the question earlier, we can look at the lead factors or the cyclical factors. So that we do have traditional bull factors and traditional bear factors that you can see people when they're in a growth spurt where it's going. So you can see those trends. I think just one thing to say that is really interesting is that if we did this a year ago, just as the pandemic was started or in the middle of it or whatever, I don't think we could tell you anything about anything, if I'm being honest, because everything blew up, of course. So I think what excites me and Simon about this set of data is that probably the reason why we were talking about the urgency of like the act now sort of thing is the fact that this is the first time in 12, 14 months, whatever, that things have visibility. Things we've seen in the model have settled down, and things are returning to the way that we can look at stuff with some comfort looking forward, whereas 12 months ago we couldn't. So I think that's where we're excited. We've seen it certainly in the last 2 months where stuff has really started to settle down so that you can make reasonable, sensible calls based on the trends that we've seen. But I just wanted to sort of throw that in.
Thank you, Matt. Thank you for raising that question. We all wish we had a crystal ball, but at least looking ahead, the next 12 months, 18 months, with the data that we have is probably right now from the analyst side is a good indicator. I think again, as I would say, we would look at indicators from other stakeholders to say where they're moving to and how are markets changing, regulators changing, consumers changing, and so on. Yeah. But great question. Thank you, Matt. If I can call on Callum Laidlaw, and then Jonathan Harper. So Callum, if Callum's still
Can you hear me?
Oh, yes, please.
Yes, great. Sorry, it wasn't letting me on mute. Yeah, my question was just looking at the top 10, at the sort of the strength and value of a corporate going through and either a sort of reputational and/or operational challenge and coming through it, because it appears that a number of those organizations have had, pretty serious either ESG or operational cyber issues, for example, come through them. And do you see that as a metric that actually allows companies to strengthen their reputation and thus reach the sort of the top levels of your assessment?
I'm sorry, the question is, do we see ESG, CSR as something that can help, something that contribute? I lost you. Can you put your mute back on?
Oh, mute.
No, sorry, my question was a company or a corporate that has been through a significant reputational challenge, like many in that top 10, is that a sort of strength going forward? Is that, do you see metrics once you've gone through something that is, to pick an example, obviously Experian had, a severe cyber issue. Has that enabled it to perform better against the metrics that you're looking at because it has been through a significant reputational challenge?
As you think that answer through, I can certainly say when we've looked at companies, we've been in this business for 30 years, those that have gone through the worst times and have actually changed as a result, really changed as a result, have come out on top. Look at the catharsis that BP is going through. Look at the challenge.
BHP, yeah.
Yeah, and sometimes companies need to fall, land on their knees, hurt themselves really badly to actually address these things that have been out there that all of us know and have probably been saying to them, watch out, watch out, watch out. And sometimes you've got to go flat on your face. That's when you learn, you go, maybe we need to do things differently. You go, yes. But they're the ones that actually have driven most of the change. They're the ones, I remember early on when we were looking at those who had better green credentials than others, people kept on coming back saying, why do you have oil companies or mining companies in this list? And I'm going, they are doing most now to protect themselves and address the issues than anyone else that's still sort of sleepwalking their way through. So sorry, that's just an observational perspective that we've seen in terms of those that have fallen. I mean, never waste a good crisis. They've learned the most.
Yeah. It's a case of, in some, it can. I don't think you can say there's a general rule that it happens. But in some instances, companies do come back harder and stronger and manage to resolve that in a serious manner. I mean, we saw certainly with BP, it sort of dropped out of the top 10 this year. But since Deepwater Horizon, I mean, it did, not surprisingly, struggle for some time, certainly in the immediate aftermath. But there was attention to that element of its reputation alongside many of the other elements of its reputation. And I think it's fair to say it did come back stronger. But then there'll be other examples, no doubt, where companies perhaps didn't learn the lesson and have suffered as a result of that.
So a test of resilience, but it's a great question, Callum. So, you know, how can we help companies falling over and help them get better before they actually are forced to? But sometimes they need to be forced to. But a good question. Jonathan, we've got a question from you. If you'd like to unmute yourself.
Great. Good morning, everybody, and thank you very much for a really insightful session. Simon, you mentioned obviously quality of management is one of the metrics. Good question really to you, Greg or Sandra. To what degree are you now and our investors also looking at diversity of leadership, whether the CEO is a diverse candidate, whether the leadership team is genuinely diverse? Because certainly in our world, and I work for Spencer Stewart, the majority of succession projects we're working on for the C-suite are related these days to diversity. So I'm just really interested in terms of the sort of weighting you now attach to that when you're looking at management, not just the quality of individuals, but the diversity of the leadership teams.
Okay, if I'd start, I'd say we start off with this sort of with that particular component, looking at something like quality of management, but then by reference to how the company and how those stories are being covered in the media, we can get the sense of what it is that's driving a company's particular strength or weakness on that dimension. So it gets tracked back in the way that we were talking about with the lady from AXA earlier on. So it does feature, and it is something which is increasingly featured, but we take it on a case-by-case basis and look to see if there is any relationship at the time when companies, as I say, do particularly well for quality of management or are not doing particularly well. It's in.
And I think just to add to that, it's a good question. I think particularly in terms of the way that when peers or investors who are asked in management today and asked these questions about quality of management, I think all the diversity issues wrapped up, of course, in their responses. So it's more from a case, I think, of if it is not diverse, which is seen as a weakness, clearly that will reflect in a lower value, if you see what I mean, rather than the other way around particularly. So I think that's probably the way it's seen through. Quality management we all think of as, okay, they're leading the company well. But a big part of that is absolutely that, is that if you haven't got that diversity there, and you know this better than I do, but clearly that's going to represent a risk down the road. So that's how it shows up. Possibly not answering your question fully, but that's how it, for sure, it'll show up.
Yeah. Well, it's such a fascinating area, and I think building on that, the other overlay is culture, which is impossible to make a subjective measure on, but through various sourcing, because you can often see two different companies in the same industry, one really performing very strongly, the other not, and often the cultural differences layered on with the management can really be the differentiating factor. So that would be fascinating for future.
That was certainly something that we saw in the years when we were tracking the likes of Unilever prior to Alan Jope. Paul Holman was creating a strong sense of culture, and that was often wrapped up with the plaudits, or the things that were sort of manifest as plaudits about the quality of the leadership of that company. In other instances, as you know, it's other factors that are coming to bear. But these things do, like cream, rise to the surface and become apparent when you sort of start asking the question, well, why is this company doing that dimension?
And ability to track talent, one of the drivers as well, that's another one that's going to show up for sure in culture, just for the fact that someone says, yes, I want to work there, or I don't, whether they do internal scores or just the external perception of the culture, that will show up in there as well.
Yeah. Super.
It's a great question, Jonathan. It's also something within Britain's Most Admired. We included diversity for the first time in the 13 criteria that we're looking at. Year before last, when we started it, very few analysts, and indeed of the sort of the peers and competitors watching each other, could even answer that question, because most had no idea what the companies were doing. So we kept the scores in there. We said, right, those who do have a view, good or bad. If you don't, we ask people not to guess, just say, if you know, please rate. But this last year, just about everyone was able to answer that question. Really interesting. One, they're looking for it, but they're asking for it. And also it's part of the narrative now. So a really interesting change coming through. So really great question. Thank you. I think we only have time for one last question. If I can ask Andrew St. George, you've got the last question of the day. Andrew?
Hello, everyone. Great discussion. I'll keep it quick. It's not a particularly sexy question, but it's really for Greg. It's you mentioned DSM, which is of course owned by a big petrochemical company called Sandra. And the question is, are more highly regulated organizations more vulnerable or susceptible to big reputational volatility?
Oh, first of all, DSM, the Dutch company, is the nutrition guys.
Okay.
Yeah, so
I thought you meant Dutch State Mining, and I was thinking of the oil.
Oh yes,
that Sandra had mentioned.
You're right. That is them, and they don't do any mining anymore. But you're right. That's their background.
Yeah.
Sorry. So I was thrown by that. Sorry. The second part of your question again.
Are more regulated organizations more likely to have a volatile reputation?
It's a good question, actually. I think probably the way I'd answer that probably is backing out in terms of the financials. I would imagine that, and somebody have to help me on this one. I would have thought they probably do, because if you just look at a proper 100% listed company and say the FTSE 100, a fair chunk of that, 50%, whatever it is, will be attributed to their financial performance, and then a bulk to reputation. But given that if you work in a very regulated industry, and Simon, again, you add to this, but I would have thought absolutely that the reverse would be true, that the majority of the risk of your earnings actually is dictated by the regulation, which is your question, I think. So
yes,
I would say that therefore, yes.
And there's less opportunity for the reputation, therefore, to have an impact as a result of that.
Okay, cool. Thank you very much, both.
More issues and more risks and things attached to it. Thank you all. Thank you for your great questions, for a really enthusiastic participation. I think it's been one of our best ever. So thank you all for joining us. As I mentioned, we'll be sending through Greg and Simon's deck, the report that goes with this, and there will be the recording up on the website shortly. So thank you. Great questions, great engagement. Sorry we have to bring it to a close, and have a happy Tuesday and happy week ahead. All the best. Bye to everyone. Bye for now.